Imagine what's possible when learning doesn't get in the way of life. At Capella University, our game-changing FlexPath learning format lets you set your own deadlines so you can learn at a time and pace that works for you. It's an education you can tailor to your schedule. That means you don't have to put your life on hold to pursue your professional goals. Instead, enjoy learning your way and earn your degree without missing a beat. A different future is closer than you think with Capella University. Learn more at capella.edu.
Reality radio for a really great future. We're talking real money.
Wow, has today been a podcast day for me? Well, it's Friday for you, but whatever. I don't know what day it is for me, but I've just recorded a lot of podcasts today. Holy mackerel. But this is the Friday Q&A podcast. You're in the right place. Thanks for listening. We call this podcast Talking Real Money for the very simple reason that we talk about money realistically. The real way it works, not the way either you want it to work or the way a lot of people are telling you it works. This is reality. This is sensibility. This is science. This is not alchemy, not psychic abilities, no tricks, no gimmicks, no gadgets. And we love to answer your questions. Both Tom and I do. And you can send us your questions by going to talkingrealmoney.com and clicking that button or those words that say contact us. And then if you want them answered on the Friday show, generally speaking, you record them with your voice and then I answer them. So go to talkingrealmoney.com. If you want to talk to us live, just call us on Saturdays from 3 p.m. until 5 p.m. Eastern at this number, 855-935-8255. 855-935-TALK, T-A-L-K. Let's do our first question, shall we?
Hi, guys. Thank you for your time. My question pertains to inherited traditional IRAs. I'm afraid to say my wife will probably be inheriting an IRA from her mother who is not good health-wise. This IRA has been paying RMD for many years. When my wife inherits this IRA, and I know there's a 10-year time frame that she needs to receive it, for lack of better words, will she have to keep taking the same RMD amount as what her mother was, or will that RMD change based on my wife's circumstances? Again, traditional IRA, just receiving it through her passing. And I kind of know about the 10-year window, but I'm not sure as far as the RMD, if that changes. Thank you.
Well, there are a couple of ways to take the money. It depends on the age of the beneficiary versus the age of the owner. But in this case, it's very likely that the owner's age is greater than that of the beneficiary. So you can use the beneficiaries, your wife's age, to determine the distributions for years 1 through 9. You can use your wife's age because she would be younger and you would have smaller distributions. But there again, at the end, it still has to be taken out completely by the end of the 10 years. So yeah, you can use the distribution table for your wife's age or for her mother's age, either way. But you still have to take it out years 1 through 9, and then it's all out by the end of 10. Thanks for the question, and let's do the next one.
Hi, Tom and Don. My question is about short-term bond funds. My understanding is that because of the continuous rotation of the holdings, the negative impact of rising interest rates will eventually dissipate. How much time would it take for asset values to not keep going down once interest rates stabilize? Thanks for your help and look forward to your response. Thank you.
This is one of those numbers for which there is no precision because bond portfolios vary so much in their structure. But generally speaking, the shorter the maturity of the bonds in the portfolio. A short-term bond fund is going to recover and stabilize much, much faster than a long-term bond fund. And that makes perfect sense because it takes longer for those older bonds to mature. They're going to have a bigger impact. That value devaluation in a period of rising rates is going to have a longer impact. But the shorter the maturity, the faster it's going to happen. And generally speaking, with a short-term bond fund, it's going to be 2-3 years. It depends on how quickly the rates stop fluctuating a lot too. And rates generally always fluctuate to some extent. You're never going to get absolute stability in a bond fund, but a higher degree of stability than you'll get in a stock fund generally. He said generally again. We have to say generally because that's sort of our qualifier. It's our best qualifier. Let's see. Go to talkingrealmoney.com. Leave your questions there or call them in on Saturdays at 855-935-TALK between 3 p.m. and 5 p.m. Eastern Time, noon to 2 Pacific. And here's another one that came in from talkingrealmoney.com.
Hey, guys. I have a question about taxes. In my brokerage account, if I don't sell anything, do I need to still pay taxes on the dividends that I get? Thank you.
At the tone, the time will be 3:14 and 20 seconds. It was keeping very good time there. Yeah, you do. You do. Taxes are due on dividends in the year they were received. What you will get from your brokerage firm, again, in a taxable account, I want to make sure we're clear here, not in an IRA or 401k, but in a taxable account, you'll get a 1099 DIV that will show the dividends you received during that tax year that you will use when you file your tax return. So, yes, you do. Sorry. You always have to pay taxes. Rarely do you ever permanently get out of taxes. Roth IRA. That's really about it. Let's take another one of your questions right here, right now.
Hi there. I have a question about ETFs. I'm with Schwab, and I hear you talk a lot about large cap and small cap, but I never hear much about mid cap. Can you give me your thoughts on the mid caps? I'm invested with large blend SCHB, small blend SCHA, international SCHF, and I'm curious to get your thoughts on where you would see mid cap blend SCHM fitting into a portfolio. Thank you so much.
Oh, what we're trying to do is make this process less confusing. And if we start saying, well, you should have large, mid, and small, we're basically saying you should own the market if you're going to do them in equal market-based market capitalization measures. And we could say, yeah, sure, underweight large, overweight mid, and overweight small because they have done better, but we try to just keep it simple by saying slightly overweight small. But generally speaking, if you own a massively diversified portfolio, you're going to have mid in your portfolio, you're going to have small in your portfolio, and you're going to have a lot of large. We just hope your portfolio has less of the large than it does the small. We could make it more complicated and say more small and mid, but then it starts getting confusing. And that's why we often say, just get a portfolio that overemphasizes those riskier asset classes like the Avantis Global Equity Fund or the DFA All World Fund, because you get the right balance. You get mid. You're still getting mid in those, but I don't know that there's a need for all of us to go put mid in our portfolios in addition to the other stuff. Thanks for your question. I appreciate it. And now it's the last one for today. These were short questions, but thanks for all of them.
Hi, Tom and Don. You guys are great. Really appreciate your work. My questions are about withdrawal now that I'm in retirement. Usually it says you take 4% and then you adjust for inflation. I don't really understand what that means. If inflation is 2%, do you then take 6% the next year or increase the 4% by 2%? Second question is, why not just take a straight 4%? And if your balance goes up or down, so be it. Third question is, if you are taking a straight amount like that, is 4% a good ballpark to last forever, or could it be higher, like 5%? Thanks a lot. Can't wait to hear an answer.
Okay, first, let's explain the 4% rule. You have $1 million invested. You take out 4% per year plus inflation. So, first year, you have $1 million, you take out $40,000. The next year, 2% inflation, as you mentioned. No, you do not go to $60,000. You go to $40,200 so that your spending ability keeps up with inflation. That's one way. That's the 4% rule. There's also the flexible withdrawal rule, which can be 4%, period. And if your portfolio does really well, that 4% period is going to rise when your portfolio does well. Although when it does less well, that $40,000 is going to decline. Who knows how far? It depends on how aggressive your portfolio is. There is no way to know the right number going forward. So we make educated guesses based on simulations, based on what's happened before. We don't know what will happen again or next. However, we've run simulations on both the 4% rule with the inflation and on what we call a flexible withdrawal rule, which could be 4% per year, 5% per year, maybe even 6% per year. And we found that a flexible withdrawal would have, in almost every scenario, from everything from a 10% bond or 10% stock portfolio to a 100% bond portfolio, would have held up in anything like what we've seen in the past. You would have watched your income rise and the value of your portfolio rise, which says that maybe you could go to 6, but there are possible periods where you would really get into trouble, where it would start to be very frightening. And the main thing you're trying to do with an income strategy is to try to avoid getting the wits scared out of you by dramatically declining markets, like the thing that people are fearing right now. Could happen, could never happen, could happen years from now. We don't know. So we believe, based on our research, that the 4% rule, and this is based on a lot of other people's research too, that the 4% rule holds up pretty well. 4% plus inflation. At least it has in the past. We do not know about the future. We also believe that the 5% flexible rule is very similar in its likelihood of carrying you through life without running out of money. The thing I like about the 5% rule is it is very similar to the way most of us lived our working lives. Sometimes you made a little bit more, sometimes you made a little bit less, and when you made a little bit less, you cut some corners. When you made more, you splurged more. So I love it. That is the way I am going to retire. If I need all the money, it's going to be based on the 5% flexible rule. If we have a good year, then we'll go to Europe. If we have a bad year, then we'll go to SeaWorld. And that's, SeaWorld's the cheaper park here. So, I'd probably not exceed 5%, but 4 to 5, good number. Flexible, even better. As a matter of fact, the flexible rule, generally it lasts longer. You're taking out less when it's going down. Anyway, thank you all for all your questions. Remember, you can send them in at talkingrealmoney.com. You can type them or you can speak them, and those get answered on the Friday podcast. You can also call us on Saturdays, noon to 2 Pacific time, 3 p.m. to 5 p.m. Eastern time at 855-935-8255. And then we'll be actually having a conversation in which we're talking real money.
The opinions and views expressed on this podcast were current on the date recorded. Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions. Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy. Information presented on the podcast is not personalized investment advice from Apella Wealth. The views and strategies described may not be suitable for everyone. This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction. Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Apella Wealth, a fee-only registered investment advisor. Please see Apella Wealth's ADV Part 2A on our website for information regarding Apella's fees and services. Apella Capital, LLC, DBA Apella Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Apella does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit TalkingRealMoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. And the lawyers get richer.